All right, what's up, guys? I hope you're doing well. James here from jamesforsythe.com. So, yesterday we talked quite a bit about basically the problem with implementing a CBDC in terms of would it cause like bank runs? Would it cause people to run away from bank deposits or even possibly like money market funds or treasuries? And how would that essentially destroy the current financial system we already have? Right? And so basically, one of the things that's kind of talked about is for the central banks to more or less disincentivize you to use it in the first place, or at least to run to it. So it's like kind of almost a bipolar sort of thing to where it's like, we want you to use this because it's safe and it's a safe haven. But if it's a safe haven, we don't want you to run to it so fast that you destroy everything else that's already there. And take your pick, sort of thing. So, with that being said, we'll head over to screen share and talk a bit about how is exactly are they going to kind of mitigate this take up, right? And that's how they're kind of defining people taking up the CBDC, right? And so moderating CBDC take up would be the most direct route to mitigate the identified risks from the potential substitution of CBDC for bank deposits and relatively low risk assets, including money market funds, right? And it's pretty much they pretty much divide this into two different safeguards. So these would be quantity based and price based, right? And so basically, examples of quantity measures are quantity limits would be like a max holding limit, the amount you could have a maximum of the amount you could hold. Differentiated limits, maybe having it a tiered system, or transaction limits, right? To where basically you have there's a limit on how much you could transact within a certain day, a certain period, whatever, right? And then there's also price measures, right? So would it have interest or anything? Would this interest be tiered? So like up to a certain point, it has, for an example, 5% interest, and anything above that, it goes down to two or whatever, right? And so how exactly is that going to work? And obviously, those are just numbers I threw out there. If it was 5% interest, I'm sure everyone would run to it at this given point in time, even considering the fact that the 1 year treasury is at 3% or somewhere around there. And that's pretty much the highest one we got right now because the yield curve is heavily inverted at the moment, at least at the time of this video, right? And so you could also have like in crisis measures towards like gate switching or having like them basically directing who can go in and who can't, who could buy CBDC and who can't, things like that, right? And so quantity-based safeguards would restrict the use of CBDC through imposing hard limits on the transfers and or holdings of CBDC. Like I was saying a second ago, quantity limits can either be stock-based, basically central banks limit the amount of CBDC held by individuals or individual account holders, um, or flow-based restrictions on the amount of CBDC that can be transferred within a given time period. Examples would be like a day or by a certain account holder, right? And so the magnitude of the quantity restrictions could be calibrated to reflect the typical use of cash in common household payment uses, right? Basically program it to reflect certain behavior, whether that be the behavior they are, whether that be how they would like you to behave or how you actually behave is debatable, right? Price-based safeguards, which would be through like fees or paying interest, right? Could be used to disincentivize holdings of CBDC or large payments in CBDC without restricting them, right? And so basically having large fees on large transactions of CBDC, but not restricting those transactions, right? And so central banks could consider paying uncompetitive interest rates on CBDC holdings to disincentivize use. And I have to note in the footnotes, as always, there is yet another comment on negative interest rates, right? And so basically, but they're like, however, the existence of cash, which has no interest, would limit this possibility, right? So basically, people, if CBDCs would go negative or would pay negative interest rates, then people would just run to cash instead, right? So with that being said, would they just ban cash, which is something we've talked about in previous videos, right? So to continue, basically the interest that they could pay could be tiered, as I say, single or multi-tiered. In a single-tiered system, holdings of CBDC would pay interest at a rate irrespective of the amount held. Single tier, there's one interest rate that I think that's self-explanatory. An example of a two-tiered system would have basically you'd have a payment or a defined threshold where CBDCs below that threshold would have a certain return, and any amount in excess of that threshold would have a lower return. Like the example I gave earlier, going from 5%, and then say, or if you have $10,000 in CBDC, it would pay 5% if you were holding it. If anything above that $10,000 threshold, it'd be 2%, just to keep the interest rates from the example I gave earlier, right? And obviously, those numbers are just made up. Absolutely nothing said about those specifically in any of the papers or anything, right? Just made them up to show the concept, right? So, in addition, central banks could consider charging a fee, either fixed or progressive, on transfers of CBDC that exceed a certain amount. Another way to disincentivize use. Um, this could be used for large transactions, basically ensuring institutions or people to use it for investment purposes. To where basically you could maybe only pay rent or something would be like the highest expense you could or highest amount you could transact. And so maybe that would be like a few grand at most, maybe um, somewhere in there. So that basically it prevents people from wanting to do like $100,000 transactions or whatever in CBDC. Basically, disincentivizing people to such a degree to use it as an investment on an investment basis, right? Purely just transactional for living expenses, whatever it may be, right? Depends on kind of who the target market is. And so a combination of quantity and price-based safeguards can also be considered. For example, a central bank could consider a two-tiered remuneration system with limits on the amount of CBDC that can be transferred within a given day, so basically combining them. Um, Whether implemented in parallel or not, the existence of the above design features would reduce the attractiveness of a CBDC as a store of value, and thus reduce the extent of disintermediation and the possible ensuring financial stability risks. Kind of unpacking that specifically, right? And so this is kind of the general theme in one sentence of yesterday's video and today's video, right? And so basically, um, these by having these fees or these tiered interest rate systems or having limits on how much you could hold or transfer at a given time, they could prevent you from, or I don't want to say prevent, well, in the terms of limits, they could, but basically they would disincentivize you to use a CBDC, a central bank digital currency, and on any form of significant basis or on a basis large enough or significant enough that it could cause a significant amount of outflows from banks on aggregate total because you're not the only one that would be using it. It would be the populace in general, right? And so, kind of slowly and maybe over time, they would increase those limits to kind of gradually transfer people over. And that's one thing we talked about, or one sort of kind of calibration framework you could think of, to where basically you start off with these lower limits and people kind of slowly get in and let the financial system adjust, and then you increase the limits. Maybe you have a little bit more outflows of traditional finance or from the traditional finance system into the CBDC system and basically slowly transfer it over, or basically play with the incentive structure there to get people to do what you want. And by you, I'm saying the central banks, right? Because it's a central bank digital currency, right? So that's kind of the whole point. And the main problem is if they kind of just throw everything out there and see what happens, you could possibly see this CBDC be viewed as a safe haven by the masses, the people who don't dive into the details, and they don't care, right? They don't really care what the implications are. They don't really look into it. They just want to be able to tap their card and go. They don't care how they pay their groceries, just that they can eat and they can pay their rent things like that, right? That's the only purpose for them. Um, and I think I went more in depth on that specific concept in the technology video, I believe, that, as always, can be seen in the playlist, right? Um, Limits could be applied varyingly for different CBDC account holders to differentiate between businesses and households or different types of households. Depending on the motivation for launching a CBDC and its framework, central banks could consider different limits or frameworks in place for households than for businesses or different households. Basically, being able to program money on a individual basis for the most part, or they could break that up and kind of segregate society into specific boxes and do it from there, right? As an example, right? So such limits could be imposed on a permanent basis or a transitional basis. Some central banks may see a case for structurally limiting the extent of CBDC take-up and risks from substitution with private money. Others may prefer to use measures only during a transitory phase to slow initial take-up and allow time for the financial system to adjust. So what I was kind of talking about earlier. So calibration of any safeguards would likely need to balance moderating the risks for high and or rapid take-up of CBDC with other policy objectives for a meaningful level of usage. Because you just don't want to have it out there and then not do anything, right? So giving examples. That's pretty much it. So implementation of tools to prevent our right. Sorry, I'm getting ahead of myself. I actually need this part. So for to continue on, right? So for an example, considering quantity limits on holdings, settlement of CBDC transactions could be guaranteed only by introducing a waterfall mechanism. For a footnote, they define this as a waterfall mechanism would enable excess holdings of CBDC arising from incoming payments that bring account holdings above a certain limit to be automatically transferred to an account held at a bank or other intermediary. Right. So with the account limits, say you're a business and you have an incoming revenue stream, and all of a sudden your account would go, if it kept receiving that income, it would go above the limit. So they basically have it automatically go into a separate account, whether that be for a bank or whatever, right? And that's kind of what they're talking about with the waterfall mechanism. I guess for them, it's more of like all the overflow. So think of like a dam, and you can kind of fill it up with CBDC up to that limit, and then any excess will just roll over into a separate account, right? At least that's what pops in my head. Um, Also, they have to keep in mind arbitrage. So, like if you have a tiered system, specifically with like interests, um, basically you could have people create a secondary market where you would give or pay people to hold your CBDC so they would have the higher interest, and you could kind of arbitrage between the two kind of tiers of interest, right? Um, so they would want to basically prevent such a thing. Um, yeah, always preventing things and not letting them work. But anyways, if the introduction of the CBDC is deemed worthwhile and its design is reasonably fit for its intended purpose, limitations on holdings may require changes to existing legal frameworks or be at odds with the general public's expectations. Although limits to cash payments for security and fraud reasons do exist in some jurisdictions, such as the EU, and that's one thing they always talked about rather frequently, more in the first two papers of the series. Um, Basically, with I forget the acronyms off the top of my head, but anti money laundering and counterterrorism funding, I think, is the direct terms they used. It's been a minute since I read them explicitly, but no terrorism and no money laundering, right? They would want to prevent that. So, if holding CBDC became an exercise in active management on interest rate risk, any public benefits tied to wide access and inclusivity may be thwarted, right? So, financial inclusion is a major proponent of or major selling point for them on a CBDC, right? And that's even a big consideration for the technology they would use in general. And so that's really what they're going for. And so basically, if you get it too financialized and too complex, you would exclude people from that kind of system, right? Because maybe they don't understand it and or whatever their reason may be, right? And that's their argument, right? So there may also be negative economic and confidence reducing effects associated with widely applying increasingly negative rates to household wealth in times of stress, right? And so that's one of those things. I mean, I think in yesterday's video, I talked quite a bit, or at least a little bit at the end, about trying to keep my personal biases out of it. But I mean, that's really what other major incentive could you have for a CBDC, right? Besides all the ones that, I'm sorry, what other incentive that is not already explicitly stated in these papers that I've gone over would be negative interest rates, right? And so, I mean, that's a major incentive for it. Maybe, and we'll say explicitly nominal negative interest rates, something that I believe has already been happening in the EU. I believe they've started to raise above zero again, but I'm not as familiar with the monetary system or that type of news for the EU um, or the ECB. I'm more kind of Fed focused in that respect. And so I know they keep real nominal rates, and I don't think it comes to any surprise that they're negatively in real respects, they're negative, right? And so it's really this would allow them to have negative nominal interest rates as well, right? And so ba- that's pretty much it for the safeguards. Basically, how would they prevent a CBDC from completely destroying the current system, right? How would it basically cause, how would they prevent such a, I even hesitate to call it an asset, um, such a financial object, right? To not completely just destroy what's already there in traditional finance, right? The whole bank runs and all of that stuff. I feel like it's just kind of beating a dead horse on how many times I've repeated it the past couple months as I've been studying and doing these videos, right? Um, but yeah. Anyways, we're gonna leave this one here. So as always, this I actually believe is the end of the series of the papers. It's finally here. So, um, and that's just the one series for the collaboration with the banks because I wanted to get their specific point of view. I mean, it's a central bank digital currency, so I want the central bank's point of view, right? Their reasoning, and I was quite surprised on how, I guess, open and honest it seemed at first. There wasn't as much kind of reading between the lines as I thought would have to be done, which was somewhat nice, I guess. Um, but yeah, now it's basically going to be more kind of niche or specific papers on CBDCs as I find them, not necessarily broad collaborations between central banks as these were. These were all published 2020 and 2021. Um, for those, and as always, you can find them throughout the playlist. There are 20 something videos as of this point. So feel free to watch those, comment on specific ones. I went through and I broke down individual parts. Trying to get concepts down. Um, so yeah, feel free to comment and start a discussion in the comments. Like that's the whole point of this stuff. I was basically just proposing and kind of going through their point of view and what they discussed in the papers, their kind of cost benefit analyses that they've done. And so not even starting on um, other ways from other ways to think about it, right? And so I would love to hear your guys' point of view. So feel free to express them as freely as possible. But anyways, I'm gonna leave that here. So I hope you guys have a good night, and I will see you on the next one.